So after last month's video, some of you in the community mentioned that you would like for me to use my own voice. And so here I am again using my own voice. Welcome to the third month of the PineScript series, where I'll be covering how to create daily chart algorithmic strategies and also talk about the process of strategy development so that you can also develop your own strategies for your own portfolio. So let's go ahead and talk about market edge and kind of what that means. We've already seen two different kinds of strategies in this series, and hopefully you've gone and coded them and kind of vetted the results for yourself and gotten some ideas for how you might also vet some of your own ideas in the market through code. But I want to talk about what it really means to trade, and that is this concept of becoming a trader rather than learning to trade. So, where a lot of retail traders fail is they have this idea that trading is something that you just learn, like a single skill or vocation. And once you have the skill, that you're going to just be able to trade the markets and make a lot of money. And the reality is that trading, at least consistently being profitable over the long run, is more like running a business. And when you understand that mindset fully, you stop thinking about trying to learn how to trade and more about how to become a trader. Because a business is going to find new opportunities. They're going to open new product lines. They're going to react as markets, as environments change. They're going to have to adapt sometimes, um, just from outside conditions. And that's what you have to do as well as a trader is, let's say you're a discretionary trader and you're really good at trend following, but then the market goes sideways for a month. You probably had a red month because you got frustrated and you couldn't find trades or you forced bad trades on the market that wasn't really part of your edge. And so this is why you can't you really got to learn how to become a trader and learn all that you can, because some of the other income streams that we're going to teach in the community, they're about exploiting market edges that are at least not singly directional, if that makes sense. So most of the trading strategies that you've probably learned are either betting on going up or down, and this series is going to be simplified to just betting up or down. But there are a lot of different edges in the markets, and if you are a trader who just thinks that the only way to make money is if price goes up or down, then you're going to be severely limited when price goes sideways and not know how to capture the inefficiencies that exist in that kind of market. So let's talk about the two main kinds of edge in markets. First one is risk premium. This can be called, or this can be thought of as uncomfortability. A common example of risk premia is the weekend effect. So this is something that has existed for decades. It's basically where certain stocks have been deemed by enough financial institutions, the institutions that are big enough to move the market, certain stocks have been deemed as too risky to hold over the weekend with a full position size. And so enough of these institutions, what they do is they de-risk on Friday. They start selling off part of their position to reduce their position size, and that selling off causes the price of those stocks to go down. And then retail traders who have been exploiting this effect have realized, okay, well, I can buy this stock. Apple actually is one of these stocks. And then I'm going to bet that nothing crazy happens over the weekend that's going to cause Apple stock to plummet or make the institutions want to completely sell out of their position on Monday. And so I'm just going to buy when it's cheaper on Friday. And then when it comes around on Monday and nothing crazy has happened, and in most weekends, nothing crazy does happen, those institutions are going to go back to full position size by buying back in, and that's going to drive the price back up. And then I'm effectively getting paid for holding over the weekend. So even though that effect has existed for decades for quite a few stocks, it's one that is well known, and it exists because those institutions, or at least enough big financial institutions, have decided that they need to be risk off for those stocks. And so you'll hear some people say that edges erode over time or that they go away. That's more true for inefficiencies, which I'll cover next, rather than risk premium. Risk premium is usually uncomfortability, usually set by some sort of risk requirements. As long as those requirements are in place, risk premium is not going to go away. So the next type of edge is inefficiency. And this can be information asymmetry, like if you have insider information and you know what an earnings report or a news report is going to be before it's officially released, then you can take a position in the market betting on a reaction. And efficiency can also be that reaction. So if a report comes out and it doesn't match expectations, the institutions are going to move price up or down, possibly. And that's going to create an imbalance of buying and selling pressure. And then a lot of what price action strategies try to capture is how do we identify this sort of imbalance, and then more specifically identify entry locations that would be really good in terms of risk reward to capture that inefficiency. And the reason why I recommend learning edge and studying and thinking about edges as deeply as you can is because everything kind of has limitations. So if you study nothing but price action, you're probably taking profit based on some sort of risk reward that's mathematically determined to give you positive expectancy over the long run. But if you were to talk to a top discretionary trader, they probably aren't thinking purely in terms of risk reward, or even um, they're not taking profit in the way that you are. So let's say that uh, there's a news report, like the Thursday unemployment claims report, that causes the market to start selling off, and you find an entry location, and then you take a short, and then you scalp out, and you get say 2R, and you pat yourself on the back, thinking that you did well. And if you never grow beyond that, then you're going to continually see that a lot of times on those kinds of days, the market continues to sell off, and you should have been holding for longer. If you are tracking your stats, you're probably going to see MFE, maximum favorable excursion, is generally higher than your profit, which might also be a way to tell you that, hey, you should be holding for longer. But what the top discretionary traders are doing is they're seeing that that report came out. So there's a news backed reason for the move. Volume increased higher than average for that kind of day. And then they'll probably look at the hedges. Is gold going up? Is Bitcoin going up? Is there fund rotation out? They're not just looking at the price chart in front of you or the higher time frame. They're looking for things that signify that there is a rotation. And if there's a rotation, there is a inefficiency that's likely to last longer than whatever 2-hour profit target you have, and they're gonna short, and they might short for any reason, arguably anywhere, and add on to their shorts. So as you're closing your short at 2R, they might be adding another short at 2R, and you're patting yourself on the back for making 2R, and then they've probably made, at least in terms of points movement, several times your risk reward ratio, because they understood the edge that they're capturing, whereas all you understood was just the price action, the chart in front of you. You didn't look at anything else, and you weren't able to take advantage of the inefficiency, because the deeper you understand the edge, in general, the more confidence you have to press and to stay in the position longer, um, or just like capture the edge better if it's not a position that you can hold for some length of time. And then the math just becomes much more favorable because you're making more profit. So your win rate can actually go down, and you might actually be making more than people who have a higher win rate. So that's just an example. So in terms of developing an edge, you want to think like a scientist rather than an engineer. An engineer is going to identify a pattern that might have made money this week and last week and maybe the week before, do a back test, see that it doesn't actually hold up over time, and then start adding rules to cheat the back test so that the back test looks good. Problem is that that's not going to guarantee that this cheated back test and cheated strategy is going to actually work moving forward. So you have to think more like a scientist of, hey, I see a pattern that would have been net positive overall. I mean, almost every pattern you identify is going to have some losers, but you see some pattern that would have been net positive overall this week, maybe last week as well. Then you say, okay, I want to get efficient, or I want to be efficient in checking this pattern, so I'm going to code it, and then you back test it. And usually the back test is not going to be amazing. It's usually going to be okay. So that's what you probably see in this series as well. We have iteration 1 of these strategies, and usually iteration 1 is just okay. But it's enough to tell us that there's something there. And so you go and you look at the strategy, and then you theorize about the edge. You can look at the losing trades, um, and it's important not to add a rule specifically just to eliminate losing trades. It's really to see if there's a certain pattern that those losing trades have, or maybe there's a certain pattern that the best winning trades have. There's two different approaches there for iteration, and I recommend both because sometimes it's not so much about eliminating losing trades as it is about filtering just so that the strategy takes the best trades. And then over time, you might realize some patterns related to that kind of edge you're capturing, and that will give you some general ideas on how to naturally improve those kinds of strategies moving forward. And then if you like the optimized strategy, one where you added like one or two more rules. In general, you don't want to go beyond 3 rules because I would say if you have like 4 or 5 rules, you're probably overfitting at that point. But if you like the strategy and the way it looks, then you incubate it, you test it on sim, check the results on sim are comparable. Once you feel comfortable on sim, that you can go live, probably with a small position size, and then check the live results as well, which will actually tell you, was your slippage in the backtest accurate, or do your commissions make sense, that sort of stuff. So in terms of the edges that we've created in this series so far, we have the January end day breakout. That's arguably an inefficiency. Breakouts are usually caused by some sort of news that causes the markets to move, and we optimize that by checking if the bar closed near its low. And that's just because we believe that before hedge funds and institutions can really drive the price higher, they often like to reposition. And that means kind of rebalancing their position, which will often create a bar closing near its low before they decide that they're going to take it higher. And then for February, we have an overreaction strategy, a bearish engulfing candle. That's kind of like an exhaustion. Exhaustion and mean reversion kind of fall in the same camp. And you'll see that later on whenever we optimize the mean reversion strategy by basically taking one of the rules from the bearish engulfing strategy to improve the mean reversion strategy. But in general, what we're capturing is an inefficiency due to the market moving too far too fast and is going to revert. Today, what we're going to cover is a mean reversion based on a 50% pullback, not based on price, but rather based on time. And then we'll talk about a different kind of channel, more modern type of channel, and creating a strategy around that. So 50% pullbacks are pretty relevant in all sorts of trading literature, and really since the studies of trading, not just in price action, but honestly, any way you look at the market, 50% pullbacks are considered relevant and statistically significant. But in general, a lot of people know about 50% pullbacks, and there might be edges in other 50% pullbacks that are not based on price. So ultimately, is there some sort of correlation between time and 50% pullbacks? Or rather, is the 50% pullback based on time? Is there some sort of edge there? So let's break this down. Relevant levels on a daily chart can be weekly levels, monthly levels. In my case, I didn't find that much relevance in half of a week ago, which is about 3 days. But I did notice that there does seem to be relevance half a month ago, so 15 bars ago. And now I know that we're looking at 15 trading days, but the weekend is arguably embedded in these days here. And so if you look at the second arrow pointing down from the left, you'll notice that the market basically tested the low from 15 days ago, or rather the lowest low in the past 15 trading days, and then bounced up and rallied. And the way I see it is that this is probably like a 33% pullback. You can't really argue to me that this is some kind of 50% pullback in price, unless you exclude like the first 10 bars on the chart. But if you do include the first 10 bars on the chart as the start of the bull leg, which is I think you'd have to, in most cases, if you're seeing this in real time, then it's hard to realize that the market basically rallied off a 33% pullback. But if you're looking to see if it was pulling back 50% based on time rather than price, then you might notice that that might possibly be a phenomena. So now if we go to the second arrow, or rather 4 arrows from the left, the one that says pull back, that's also basically testing 15 bars ago. You can also argue that's closer to a 50% pullback in price, and I would agree with that. But if you bought that pullback there, you'll notice that the bulls attempted to resume the trend, and even though they failed to resume the trend, you would have still made money buying that pullback. And so there are a few other cases here that aren't annotated. Some of them lose as well, but of course no pattern is going to win all the time. But you'll notice that SPY, which typically is in a bull trend because most years the market is in a bull trend, SPY typically, if you were to buy anytime SPY tested the lowest low from half a month ago, you would have been net positive overall. And so just to verify it, we've coded it. Now you'll notice I've titled this Daunting Channel Mean Reversion, and that's just because I think his name was Richard Donchian. He originally created a channel that is based on an in-bar look back. And I'll talk a little bit more about this in the next slide after this. But you look some in-bars back, in this case 15, and then you check, did today close below the lowest low of the past 15 bars? And if it did, then we enter long, and then we exit when the day closes higher than previous day's high. So this is what you get. Pretty good, honestly. About 3.5% drawdown, assuming 70 shares traded on a $50,000 account size. You would make roughly $3 for every dollar you risked, which is excellent. You win about 3/4 of the time. And it takes about 236 trades, and this is backtested all the way to SPY's inception. And so, I do like everything I see here, and you could trade this as shown here. But I want to talk about channels a little bit. So there's Daunting channels, which are kind of the older historic channels, and then there's Keltner channels. So Daunting channels are what we just developed a strategy for, which is highest high and lowest low in bars back. It was originally created for identifying breakouts, actually, not mean reversion, in mostly range-bound markets. So this is what a Daunting channel looks like for the strategy that was just shown in the previous slide. This is the if it closes below the lowest low of the past 15 bars. And you'll notice that the channel is basically created by looking on every bar's close. It's going to look for the lowest low of the past 15 bars, and then it's just going to connect the line to that lowest low, and then it's just going to keep connecting every single bar, looking back 15 bars, and that's what creates this channel. So the more modern channel is a Keltner channel. This uses a 20 EMA as its basis. And then it looks at the 10-day ATR, average true range, and then creates channels based on standard deviations of that 10-day ATR. So this is a more modern way to think about risk because it's based on the range of price moving or volatility, and that's considered a more modern way to gauge risk. And so this is what a Keltner channel looks like. So to take what we've done with the Daunting channel, we can also backtest it on the Keltner channel and kind of see what the results look like. So iteration 1 here, same rules, except rather than a Daunting channel, we're just using closing below the bottom of the Keltner channel. And this is the result. So you'll notice it's pretty similar to the Daunting channel. The net P&L is slightly lower, and that's because the max drawdown is slightly higher. And I say this even though the Daunting channel strategy took about 30 more trades. Even though this one wins a little bit over 80% of the time, so it has a higher win rate, profit factor is less, even though it wins more. And that's, again, because when it does lose, it loses more. So earlier I was talking about how you can look at the results and see if there's a way to further improve the strategy. And there's two common approaches. Well, there's several common approaches, but I would say that the two most common are you look at the losing trades and see if there's some sort of pattern to the losing trades. The other one is to look at the winning trades and see if you can just identify a pattern among the best winning trades. And it's important to consider both because you might find a pattern that uh, that works for reducing some of the largest losers, but might not actually make the strategy as efficient as if you just optimize for uh, the highest winning or most efficient trades. And so, since this is a mean reversion trade, and most mean reversion is best when there's some sort of overreaction. You know, whenever the edge that's being captured is an inefficiency where the market has moved too far too soon or too quickly. And so, the idea with most mean reversion strategies is that you can try to capture that when there's no opposing tail. In this case, for iteration 2, we're just going to add a rule that says today has to close in the bottom 15% of its range. So it has to close below the bottom of the Keltner channel, and it has to not have much of a tail. So more likely to be some sort of overreaction that's going to have some sort of short-term correction. And with this, what we get is 50 less trades, roughly, a higher net profit despite taking 50 less trades. The win rate is even higher, and profit factor is, well, you make about $4.50 for every dollar you risk, which is insane. And the drawdown is somewhere between iteration 1 and then the daunting channel strategy. So between 5% and the 3.7% that the daunting channel strategy had. So this one I really like because the higher that we drive the profit factor, generally the less trades that are taken, and it still has it. Well, this one has an even higher win rate, and this is just again, this is what happens when you optimize for winning trades more than the losing trades, and so you're filtering out both losing trades and winning trades, and just focusing on can we just capture more of the highest winning trades here. And what this does is, again, it allows us to, by reducing the number of trades, it allows us to have more uncorrelated strategies as we're building our portfolio of multiple trading strategies. So in the next video, I'm going to show how to build the daunting channel strategy as well as the Keltner channel strategy. And for those of you who are interested in building day trading strategies, I especially think you'll like uh, the next video just because a lot of the concepts in terms of channels and support and resistance and lines, um, you know, you're going to want to be able to utilize that for your day trading strategies, most likely. And so this is kind of our first segue into being able to incorporate other indicators into our strategy development. So thank you for watching, and please watch the next video as we dive into actually coding these.